In this lecture, I want to show you what is leverage, how do we assess it, and what are the main leverage, also called the solvency ratios. Now, when it comes to leverage, if we look at the balance sheet of a company, we can see that this is comprised of two main sections, an asset section and a liability and equity sections. This means that the company, in order to buy the assets, which are resources that will generate future profits, it can do it actually in two main ways, either by taking on more debt, therefore generating a liability or a future obligations, or actually by putting the money into the business, the shareholders' money. And those are the two ways in which the company can acquire those assets. But when the company actually acquired the assets through debt, the company is going to end up paying interest on this debt, and therefore this interest will make the company less profitable and also more risky. Let me show you an example here. Let's say that the company in this case has, for example, a long-term debt of $5,000, and due to this debt, the company is going to pay $175 of interest on this capital here, on this money that borrowed from the bank. And therefore the profits will be lower. But let's say the case in which the company long-term debt is going to skyrocket and eventually the company is going to pay a much higher interest in 1 year. Let's assume this scenario in which the company has $100,000 of long-term debt. As you can see, automatically our interest skyrocketed as well. And in other words, our net profit, actually our income statement showed before net profit, and now we have a net loss of $1,050. This is what happens when a company takes on too much debt and is not able to pay for its interests back. And sometimes it is true that a company which takes on more debt is able to also acquire the resources that will generate more revenues, but we have to strike a balance. For a company to be very efficient from the financial standpoint, it has to have a balance between equity and debt. That's what we call in finance optimal capital structure. Now, there is not a perfect number for it. There is not a way to say that a company has to have this amount of debt compared to equity. For example, of course, if you operate in a high-tech context, you don't want to take on too much debt because you know that if the company is not going to be able to actually have the same amount of revenues, is not going to be able to pay for its interest expenses anymore. And the way to assess the leverage, of course, is by looking at the balance sheet, and we are going to look mainly to the total assets and the total liability and also the total equity. So we're going to look at everything that we see on our balance sheet to assess the leverage of the company. And also we're going to use our main leverage ratios, which are the debt ratio, the debt to equity ratio, and the interest coverage ratios. As you can see, while the first two are actually expressed in a percentage number, the third one is instead expressed as a number, as absolute number. And we're going to see why. Now, the leverage ratios actually help us to assess for every level or risk if we are having actually the right reward. In other words, when we invest into a company, we know that that company is in some way risky. It means that the company can anyway go bankrupt. But we want to know if that company is giving us at least the right amount of reward for taking that risk. And that's why the first thing that we do, we assess the level of total liability over the total assets. And therefore we go on and we take the total liabilities from our balance sheet. So this is the number for total liabilities, and then we take the number for total assets on our balance sheet as well. And as you can see, we have a percentage which is 40%. What does this number is telling us? Well, this number is telling us that of the assets that we acquired, 40% of those assets were actually financed through debt. Now, this is a good sign. Usually when a company has a 40% debt ratio is not that high, we can say that the company is not too risky. But again, this depends in the industry in which we are operating in. And also we want to see whether this ratio is increasing or decreasing over time. A decreasing debt ratio is sometimes a good sign, although your objective here is not really to decrease the debt ratio itself unless it is very high, but it is to keep it stable. So when you see a debt ratio which is stable over time, this is definitely a very good sign. And then on the other hand, if you see a debt ratio which is increasing and which is increasing too much over time, this can be a bad sign. Let's take now another measure of leverage, which is the debt to equity ratio, which is given by the total liabilities that we can find on our balance sheet. And then we take our total shareholders' equity, which we can find on the equity section of the balance sheet as well. And as you can see, we have a 75%. It means that actually the liabilities are 75% as big as equity. It means that the liabilities are actually 3/4 the equity. And that's a good sign when we have liabilities which are actually smaller than equity. And we have to worry when we see like a relationship in which liabilities are twice as equity, and therefore a relationship or 150% or 200% compared to equity. It's a good sign, and therefore the company is using an optimal capital structure. The interest coverage ratio is a measure that helps us in assessing whether a company is going to be able to pay for its interest expenses. And that's what we do. We get the operating profit from our income statement. And then we want to get our interest expense as well, because we want to know what's the relationship between the two. And of course, you want to make this number positive. So you put a minus sign before. And as you can see here, our interest coverage ratio is telling us that our earning before interest and taxes is 11.4 times bigger than the interest expense. And that's definitely a very good sign. It means that the company is healthy and it's going to be able to pay for its interest expenses 10 times over. So this is a very good sign for the company. And when we see an increasing interest coverage ratio, it's a very good sign. And when we see it decreasing over time, it can be worrying. And that's why in this case, we don't have to worry, because the company is in a very good financial position. And those are the main leverage ratios.